we're on a footing now where even if Mother Nature does throw a curveball or two at us, the changes that have been made are putting us on such much more of a solid foundation than the house of cards that I kind of mentioned earlier.
Insurance is supposed to be for catastrophes. And I think we've all gotten a little bit soft thinking that it's for everything. And I blame the health insurance market for this.
You know, we view the financial world, the financial planners, as the quarterback. And we're kind of that wide receiver that's out there to say, hey, we're going to talk to Jon about this because we want to have a conversation and make sure the left hand's talking to the right hand.
Welcome to our show today, everyone. I'd like to warn you that we are going to talk insurance, and sometimes people think, oh my God. But today I have a great guest joining us. I have Crosby Warren. He is an insurance advisor and partner at Cox Insurance here in Minneapolis, St. Paul area, specifically the St. Paul side for those of you that know the difference. And I'm going to ask Crosby all kinds of fun questions about insurance, and everyone's going to be excited. So Crosby, with that, welcome to the show.
Well, thank you, Jon. I appreciate it. Thank you for the invite to discuss this wonderful topic. Hopefully your listeners will get a couple of nuggets about something that affects a lot of people, right? If you have something to protect, this is something that is almost required and again, impacts so many different households. And happy and looking forward to kind of covering all the bases with you today. And again, hopefully provide some good takeaways for the listeners.
Yeah. And for our listeners, when we talk insurance today, we're not talking about life insurance and all the stuff that people sometimes equate with that. We're talking specifically about the risks around homeowners, car, umbrella, the things that a lot of people don't really like, don't understand, and they're probably, quite honestly, not happy about right now. So with that warning, Crosby, let's start on that front. Homeowners insurance over the last few years has felt like kind of a little bit of a chicken and an egg scenario, and it just keeps going up in price. No one understands why. So let's just start there and talk a little bit about why has this part of the world changed so fast and basically feels a little out of control. But I'll let you tell us if it is.
Yes, the consumer fatigue has been something that's been significant for folks. And that's dated back maybe to about the last 7 years. Now, prior to that, Jon, we had some great decades of insurance in the insurance world, meaning that for the consumer, the contract was as in particular home insurance was very consumer beneficial. There was replacement cost, low deductibles, and if somebody had damage, they had a very small deductible, and the insurance company wrote the check for whatever was at issue. Right? It was a great run for a long time, but we started to see pressures onto the insurance industry. And so what started to, I would liken to kind of like a snowball rolling down the hill. It started to pick up steam. It started to pick up size. And really what these pressures were was a lot of inflationary pressures, whether it was building materials, the COVID spike of the kind of the 2020 timeline where you'd go to Home Depot and see a 2x4 for $12. Right. Or just a lot of those building materials were certainly impacted during that time frame. And also what we've also seen is the labor world. The cost of getting good people out to do work has gone up enormously. It has really exploded. And those decades that I mentioned where insurance companies were able to manage their profitability with the contracts that we're offering, it became almost a house of cards where the legacy contracts that were out there really started to impact insurability with these carriers because Mother Nature started to increase frequency with certain regions of the country. In particular, here in Minnesota, we were kind of in a river of severe weather that over about I'd say 5 or 6 year period that really impacted so many people having new roofing, new siding, etc. And we got to the point where there was a market correction that was needed. And so what that market correction, it took a couple of different forms, but over the last, I would say 6 or 7 years, um, it started with rate. And so the consumer getting that renewal with their home policy, those prices started to increase by 20, 30, even 60% increases year over year. That client who's seeing that increase, there were no claims, no drastic credit changes, nothing at all. It was just strictly rate. And so that was kind of first. Second, we started to see companies adjusting contracts. And really what that led to was, the convective hailstorms have really been the number one issue in this industry. So the hail, the wind, tornadic activity, stuff like that, really started to impact how insurers could insure properties. And so the actual cash value endorsements were started to were added to home policies, and then also large wind hail deductible requirements. So really, the consumer had to have that bit of self-insurance, right? They have, lack of a better term, the homeowner really has that skin in the game now. If there is any damage to the home, whether it's the contract or whether it's higher deductibles. So that's been a shift because, again, Grandma and Grandpa's policies were full replacement with that very low deductible. But also the contracting world understood that as well. So you have many years of contractors, a hail event happens in the Midwest. All of a sudden, those contractors swarm the area. And there are certainly people with legitimate damage, but storm damage can be very specific. So one street can get really pummeled by a hailstorm, and 2 blocks over, not so much. But again, the contracting world really, the door knocking world that so many people see after an event like that. Also, so people were getting roofing replacements when they truly didn't need it. And also, we'd have a customer that would have 3 different quotes for the same damage and thousands of dollars separating those quotes. So you get to price gouging, you get to, the contracting world taking advantage of things. And unfortunately, changes needed to be made because we need that consumer, that homeowner as part of the claim equation to help with the contracting world to make sure that A, we truly have damage, and B, that we're getting a fair and honest estimate from them. So, that's just kind of an overview of some of those impacts that the industry has seen, and those changes needed to happen. The market needed to correct itself because otherwise everyone would be looking at $10,000 to $15,000 a year premiums for basic home insurance.
Part of the equation, just on the back end, is how the insurance company invests the money and makes a return on it as well. And with interest rates higher, the insurance companies probably are making a little bit more on that money. So how has that, and maybe you can't answer it, but how has that played into how fast premiums are going up?
Well, that has certainly helped. At least solidify more of the numbers on the back end. I mean, when we talk about insurance companies with loss ratios, it's still the whatever was happening. To your point, investments and companies being as smart and effective as they can be on the back end, it still was these losses that it was almost impossible to try to level that out with what was happening. A quick example is, from 1980 to, I would say, right around 2020, John, we averaged about $7 to $8 billion events in the United States as a whole. So you have one catastrophic event, we would have again $7 or $8 billion events. If you look at from 2020 to 2025, we average now $23 billion events in the United States. So you can see how that frequency has really accelerated beyond even what the actuarial world of the insurance folks could even predict. So it really, that snowball kind of smashed against the wall, and so many things had to change. Because what we saw as well, and I'll just use Minnesota because obviously that's something, a market I'm very familiar with. We had multiple insurance companies that chose not to do business in Minnesota anymore. Those were the stories of the Floridas, the Alabamas, the Californias of the world, right? Because the hurricanes catch the headlines, the wildfires catch the headlines, but it truly is those convective storms that are certainly much more frequent and have just gotten to those cost points that they are on level with a lot of these bigger, headline traditional events that can happen.
Let's bring it down to the consumer, because part of this podcast is all about what's going on with the intersection of health, wealth, and time. And this is a wealth question a little bit. At the consumer level, what should people expect over the next few years then, as far as premiums go? Because, and the second part to that question really is, everyone says, I'm just going to shop it around. But we're finding that you can shop it, and yet a lot of companies aren't going to give you a better deal. So just talk about the next few years as you see them.
The good news is that we are emerging from the hard market. Okay. At where we stand today, being as an independent broker, we work with multiple carriers. So we're having multiple conversations multiple times a year with these insurance companies. And the good news is that with all of the changes that we've had to go through, is of course, as well as the consumer, we're on a footing now where even if Mother Nature does throw a curveball or two at us, the changes that have been made are putting us on such much more of a solid foundation than the house of cards that I kind of mentioned earlier. So consumer-wise, things are going to start to level off. I liken it to, we've been climbing a hill for quite a few years. We're just getting over the top, and we're going to start to level off. That means rates stabilizing and possibly reducing. Okay. Will they get back to pre-market correction? Absolutely not. That's just not how this works. But the good news is that, that consumer fatigue that I mentioned earlier, I mean, we've been weathering 20, 25, 30% increases year over year. And so seeing actual flat renewals is a ray of sunshine. So a consumer can understand and start to maybe expect that. The other thing that they also have to do is start to, consider a little bit more management on their end. And what I mean by that is, there's a lot of things that are involved in insurance pricing. Yes, it's the experience of the carriers and the loss ratios and all the things that we discussed, with Mother Nature impact, but credit's a big part of it. So someone, just like if they're looking to get a loan or whatever it is, credit is so critical to make sure that you kind of keep a good level there. Managing insurability is another thing. So I guess the question is, when do you make a claim and when do you not? When do you self-insure for small things, right? So those are parts of what a consumer can do to put themselves on the best premium footing moving forward. Insurance is I call it kind of a silly product where it's very expensive, right? At least this day and age, it certainly is. And could be a negative if you actually use the product, right? So if you make a claim on the wrong thing or a small thing, it can actually cost you more in the long run. And so that's where education and really understanding and having resources to just, to go over scenarios, those are critical for people to actually be just a better educated and better equipped consumer as we've gotten into these very expensive price points for the coverage.
Yeah, but you bring up something that I find interesting. Insurance is supposed to be for catastrophes. And I think we've all gotten a little bit soft thinking that it's for everything. And I blame the health insurance market for this, because we think that every time something happens, insurance should cover it instead of us just going to a doctor and paying $100.
Yeah.
And so what what you're bringing up is the fact that in homeowners and car insurance, the answer is it's for catastrophes. So to that point, any tricks of the trade where you say, here's the size of a catastrophe before I'd make a claim?
Everyone has a threshold, and it's different for every person or every household, right? Somebody with a $5 million house is going to have a little bit of a different threshold than someone who has a $500,000 home, right? But with the changes that have been made in this industry, people have to understand that there is going to be a self-insurance component, right? And you brought up a good point where the consumer does have to change that mindset a little bit to understand that this coverage is truly there for the catastrophic, the big events, whether it's a house burning down or a bad auto accident where we have injuries or lawsuits, right? Of course, we're going to use the insurance for those bigger events. That's what it's there for. And the trouble that folks have gotten into is making these smaller claims, because when an underwriter looks at pricing or eligibility, John, and there's some claims, it's not the dollar amounts necessarily, it's the frequency, right? And so that's where you make well, I only made this claim for $4,200, right? Well, it was a water claim, which is chargeable because there can be chargeable and non-chargeable claims, right? And then all of a sudden, 6 months later, you have an event that we truly have the insurance for, right? Like a $250,000 broken pipe, right? We're going to use the coverage there. But in this example, we have 2 water claims within a short period of time. All of a sudden, that client's going to get a cancellation letter at renewal. And then all of a sudden, they're going to a surplus market. And so then they're going to a non-admitted high-risk carrier where they're paying triple what they were, and the contract is not as good. So that's where education comes in. And you got to, as a consumer, there's so many preconceived, ideas about insurance, right? And it's the industry's own fault, right? Price. Everything's a commodity, and it's all the same. And unfortunately, it's not. And there are certain rules that we try to have to play by to put ourselves on the best footing, to work with the best carriers, to get the coverage someone truly needs, again, at the best market pricing that we can find.
So you bring up the right question, which is, let's talk terms. So getting into what some of these contracts are saying, what do you see are the 2 or 3 things that people should really focus on where these contracts have really shifted in the last year or 2?
Yeah, and again, I'll be specific to Minnesota, but this is a large part of the country. And what I would say is people definitely need to be aware of how or what their home policy is providing for them. And, the main areas are, of course, roofing here in the Midwest. Understanding if I have damage, do I have an actual cash value policy now? Meaning that if I have damage and my roof is 10 years old, is the insurance company going to depreciate that loss settlement, right? The money that the insurance company is actually going to write the check for. I try to frame it like a vehicle, right? You buy a new car, you drive it off the lot, it's going to reduce in value. And the consumer has to understand that that is how most of the policies in the Midwest are going to be structured. So if your roof is 10 years old, the insurance company is only going to give you about 85% of the claim to replace that roofing. So that's a big thing to understand. The other thing that has snuck up on a lot of folks are deductibles, of course. So, the days of, again, a $500 deductibles for all losses, that's kind of gone. Now, most people for a home policy in particular will have 2 different deductibles. Number one is a non-weather deductible. So that's for water, that's for fire, that's for burglary, vandalism, stuff like that. And then we have a wind hail deductible. So anything Mother Nature throws at us, whether it's straight line winds, tornado, hail damage, then we have typically a higher deductible there, right? It could be 5,000, could be 10. It could be also a percentage of what you insure your house for. So if you have $1 million home that we're insuring for $1 million, as an example, you have that 1%, it's a $10,000 deductible. If you look at coastal areas, that deductible is probably going to be 2, 3, or even 5%. We've got clients in Florida having, significantly higher deductibles there, but that's more of a hurricane specific risk. But it really does, and that's been around for quite a few years, of course. But the Midwest, that percentage has really been a big change for a lot of policies for people. So those are things to really think about. Companies are starting to limit some water damage thing. Here in Minnesota, we've got quite a bit of basements, type of water infiltration, in a lower level. There can be some exclusions there. So people really need to understand the risks for themselves. Is your basement finished? Is it not? Do you have an exposure there? So those are things that people really need to start to drill down on, and maybe flood insurance is something that they might want to add on, because the big exclusions that are historical for home insurance are earthquake and flood. So not going to like a broken pipe, that's covered, internal water, but water comes in from the outside, that can be something that can sneak up on people, and all of a sudden they get denied a claim because it's considered a flood from the adjuster. So,
just out of curiosity, when you go to shop a policy, I've noticed when clients share that with me, if they had 3 or 4 insurance companies look at it, each one's way different based on how much they want to charge for homeowners versus auto. So you might have one with high homeowners, low auto. The next one will have high auto, low homeowners. All the pricing in aggregate probably is close in gross number, but why do insurance companies do that? Which, is it some focus just on auto versus home? And just explain that to me.
it's loss history. Where has an insurance company, been impacted by claims, right? Where is their loss ratio higher than others? And that's going to be a little different for each company. Now, and also different carriers, John, or insurance companies have certain appetites for different things. An example here, some companies really like older homes, as an example, right? They have good programs, they have good loss mitigation practices, and they do better with older houses, where there can be other carriers that like newer homes, or some like the city. Others will do rural properties better. So there's a lot of behind the scenes appetite that can impact what someone is seeing on their overall portfolio, right? Another example is, when you look at carriers, it also is where do they want to be in 5 or 10 years, right? Do they want to be with their overall portfolio? Do they need to push more home insurance, as an example? And I wouldn't say push, that's not the right word. But do they want to be more aggressive in certain areas than others? So every carrier is a little different. That's the benefit of working with an independent agent, as an example, because you have multiple companies that you can look at. Because, to your point, every carrier is a little different with how they've, what their experience has been leading up to that rate. And again, what are they looking for in the future, and where do they want to grow? A lot of companies, they can put restrictions and moratoriums on certain areas because they're oversaturated, as an example, right? And so then they start to maybe get a little bit more aggressive, a little bit more price focused in other areas as well. So there's a lot of factors behind the scenes, but understanding kind of the broader market can be beneficial for a consumer to kind of take a look at multiple areas.
Okay, so now you bring up the next point, which is a consumer will look at that and say, how about I buy the homeowner's insurance from this company, but the cheaper car insurance from that company? And now they start splitting companies. I've always experienced, I guess, with some scenarios that that's not a good thing, that you don't want to necessarily split companies. Can you speak to that?
Yeah, and I'll be clear, when an individual comes or a household comes to us looking for help, we always want to focus on just having everything with one carrier. There's certainly a pricing component, okay? Um, but even more so, there's an eligibility component because a lot of the best carriers, John, the best insurance companies, um, they require a full package. And when I say a full package, most of that at a bare minimum is going to be like a primary residence and then an auto component. Obviously, we want to see the umbrella as well. If there can be certain scenarios where, if somebody has a cabin or a secondary property somewhere, we might have to do a one-off with another provider. But if we can, that's what we want to do. Have it with one carrier. The other big component that people sometimes forget about is if we do have a big event, a big loss, and it spans or the scope of that loss is over two insurance or two policies, like a home and an umbrella, as an example. If we've got two insurance companies working on that same situation, there can be some heads butting a little bit. Whose attorneys are going to be handling the litigation? Who's handling the communication? All of the ins and outs of that loss. There can be a little headbutting between the companies. And unfortunately, that's usually at the expense of the consumer experience, right? So sometimes it is what it is, and we have to piece together a plan. A lot of times that's underwriting related. Maybe we've got some activity like claims on a house, and we have to go to a different market. A lot of times it's driving records, youthful drivers getting in trouble, somebody having like a major violation, like a under the influence loss. That's where we start to have to piece things together. Again, always focusing on getting the client the right protection they need, but it's not always ideal to have, of course, kind of a piece together situation for those items like I mentioned.
I'm glad I'm still given the right answer to that question. Let's jump into let's give a few tips here. I'll see if your list is the same as mine. What are the 3 to 5 things that you think everyone should be thinking about when they do these put a policy in place? And, or the opposite of that's true too. Like, what do people miss?
Well, what people have to focus on, and I'll talk about home insurance first, John, is the coverage for the house. That can be a misrepresented number because people will have a misnomer of, well, I could sell my house for X dollars tomorrow. Why wouldn't I insure it for that dollar amount? Or, I bought it for 5 or 10 years ago for X dollars, and the county assesses my taxes at this value. So why is it something different? The lens people have to think about, homeowners and consumers, is that number actually represents a rebuild value of the property, right? So it's not what is that house truly there today. It's we have to come in and remove the debris and rebuild it brand new, same size and quality. So that number is much different than what you could sell it for tomorrow. So really understanding that, because so many folks will come to us for help, and that number is off quite a bit. And if you think about it, even from like a financial planning and a net worth side, most people's primary or even secondary residences, that's a big part of their assets, right? And so making sure that you've got the right protection in place for an asset like that, that's critical, because what insurance really is there for is to, again, we've talked about it for the big stuff, but trying to avoid significant out of pocket. Because if you don't have the right protection for a house and you have that total loss, people could end up paying, or if you don't have the right coverage as well, or a contract, people could be paying thousands and thousands of dollars out of pocket to put actually that home back together. You think about the fires that were out in California in the Palisades. So many people are underinsured. That rebuild in a widespread event like that, people, their policy is probably covering them for 3 million and the true rebuild is 6.5 to 7, right? And imagine what that does to someone's financial situation. They probably can't rebuild. So it's something, so a little bit of a long-winded explanation there, but that's something that I want folks to think about when they're thinking about home insurance. Um, the other piece that I would say is, at least on the house, is estate planning tools like trusts, those types of things. They get missed being listed to the home policy. And that kind of is a little bit of a curveball for folks. Um, and the reason why that's important is if there was a liability event, like a slip and fall or the dog bites the neighbor kid, something like that, and we have litigation, the consumer or the homeowner would get sued, but that trust could also be brought into litigation as well. And so making sure that the policy responds for the homeowner as well as the trust, it's kind of like, again, dotting the I's, crossing the T's, making sure that we've got that extra step. It doesn't cost any money to add a trust. It's just kind of like adding a mortgage to a policy.
Yeah. And what you're talking about there is just adding the trust as an other insured, right?
That's it. It's just a clerical step
Yeah.
that unfortunately gets missed so often, unfortunately. So those are a couple of things that I think people need to think about. Again, on the house side, just understanding the contract, wind hail deductibles, again, sneak up on people. They need to understand what changes have happened to their home policies. So really, again, I think those are some of the big things on the home side. When you think about auto or someone's overall plan, driving a motor vehicle is the largest exposure a household has every day, right? And it's not only necessarily the homeowner themselves, getting hit by or causing an accident, but actually being a victim of like a hit and run or an uninsured driver. Those are big things that those limits on the auto side, John, can sometimes be overlooked, where someone has minimal coverage or, base coverage like 100, 300, 100,000 per person for 300,000 for an accident. That's great for a college graduate, but someone who's got 2 houses and, has become successful in their own right, that's just, it's not a good limit. And of course, that kind of is a nice segue into what other is an area people miss too, is the umbrella protection. There's so many people that still to this day come to us for help and have overlooked that step. And just as a quick education, the umbrella piece is excess liability, and that's providing that consumer, that client, extra liability protection in the event of a lawsuit, whether it's motor vehicle related, they cause an accident, hurt somebody, or they've got that dog bite claim, right? So making sure that extra step in that policy is part of of their overall plan is really critical. And as you look at it, I would say at least 95% of the consumer world should have an umbrella, right?
And how much?
Well, that's another good question.
Right.
And from our chair as an insurance advisor, we usually don't know what's under the hood, meaning we don't know where people's net worths are. We don't know what they've accumulated. We don't know if they've had liquidity events or inheritance events that has really changed the financial picture. And that's where working with professionals like you, John, and your organization and just the financial planning or wealth management world as a whole to really understand what are the risks in exposures, because you would know better than me, there are retirement vehicles that are protected from litigation, right? And there are some that might not be. So really understanding and having a team for that consumer, having those resources and making sure that there's some synergy there is really critical for a lot of folks. Making sure that that conversation is coming up, and that comes up in so many meetings with our clients where we talk about the umbrella, because we're always offering higher limits. And that really starts to get the wheels turning for people. And, they'll come to me and say, Crosby, what's the right number? And I say, I can kind of give you an idea of what, the equation is, but I truly don't know because I don't know exactly what's happening behind the scenes. And we always want to get the financial professionals involved, to make sure, again, that consumer boardroom, we view the financial world, the financial planners, as the quarterback. And we're kind of that wide receiver that's out there to say, hey, we're going to talk to Jon about this because we want to have a conversation and make sure the left hand's talking to the right hand on that type of a risk.
But to that point, what I've run into is a lot of people want to insure from an umbrella standpoint, because umbrellas start at $1 million. They go up in $1 million increments, right? And everyone's like, well, I'll just insure my net worth. But that's the wrong number in my mind, because your net worth subtracts debts, and people aren't suing you based on the fact that they're going to subtract your debt. So what I always tell people, and maybe I'm wrong, you tell me, is we should be insuring your asset levels.
I would agree. Yes. And what is exposed, right? What could be brought into a lawsuit? If worst case scenario happens, you have a once in a lifetime liability event and somebody's suing you for $2 million, $2 million, right? So, and there's probably not a magic number out there. So if people are in between, it's usually just a couple $100 to go from one level to the next, right? So if we're going from 1 million to 2 million, a lot of times it's just $200. So you just dial it up. And so if there's ever any kind of question or even any nervousness, I ask a lot of clients when we're sitting down for renewal, I ask them, what's keeping you up at night? Well, little Timmy started driving and, he's looking at his phone all that. I mean, those are things that we want to address and talk through. And if that means, increasing an umbrella to a certain limit, or, just again, too often in our industry, historically, it's been so transactional where, someone goes online and kind of does it themselves, or they work with a call center somewhere, right? That's a good solution for some people. But I think when we start to talk about people in households that have a lot at stake and a lot of exposures, they need to think about taking that extra step and working with people that they can actually get educated on and really talk through to make sure that they're getting the coverage that they need.
So I'm going to throw you a softball. In the umbrella world, there is the old uninsured, underinsured motorist question. I'm going to let you just throw that one out there, because it's one of probably the main things I see missing from so many people's policies.
Well, just a quick explanation for the listeners. An uninsured, underinsured event is if you're driving, minding your own business, and someone flies through a stop sign and hits you. It's 100% their fault, right? You're injured. You got to go to the hospital. Maybe it's something even more severe. We naturally would go after that individual, right? The at-fault party. But we've been talking about high premiums. We've been talking about insurability. Unfortunately, not everyone's going to have the highest limits because they're trying to save premium because of how expensive these policies are. So they go with, let's say, an example of state minimums, $30,000 per person up to $60,000 for an accident here in Minnesota. Boy, that's not going to go very far, right? Or we get a hit and run situation, right? Which can be out there. And a lot of times, unfortunately, in these scenarios, someone doesn't have $5 million in the bank to go after, right? So we hit a dead end, and we have to come back to our own policies for pain and suffering, lost wages, out-of-network medical care. A couple of years ago, one of my insureds had an uninsured, underinsured claim. We had to outfit his home with wheelchair accessibility, right? All of these costs add up. And the uninsured, underinsured is a very broad protection. Now, most states will require it on the underlying auto policy, right? So anyone buying a policy, you usually will have that, depending on the level. Now, if it's a large incident, Is it enough? Is 300,000 enough? Is 500,000 enough? Different exposures are out there. Different people, in the middle of having kids at home, and being an high wage income earner, that's a pretty big exposure if something happens. But it's maybe not as big if you're retired and you have a nice nest egg. And so everyone has to kind of weigh their needs and their exposures and what they truly want. But having it on the umbrella is something that we recommend for all of our clients. It just depends on the level. Now, the tricky part is not all of the insurance companies in the marketplace, Jon, offer this protection on an umbrella. The big names that you hear on the radio and see on TV, a lot of them have taken this off the menu, right? They understand that these losses are becoming more frequent. And we've also started to see the severity of these losses, the costs increase significantly, just like everything else. So a lot of the bigger carriers just decided to not make it as part of an option, unless you've been with them for 30 years and you've had it. So there takes a certain carrier to offer that on the umbrella side. It also takes another type of carrier to offer more than $1 million in certain cases, right? So again, they're out there. Those options are out there. But from my chair, if you've got a household and you're driving a motor vehicle, it is a big exposure. And at least having $1 million on the umbrella for your uninsured, underinsured, it's critical. It truly is. The other reason is if anything motor vehicle happens. So what's also brought into this is riding a bike or out for a jog, or you're a pedestrian, out for a night evening stroll. That's also where your auto policy responds first. And that's where an uninsured, underinsured situation would also present itself as well. So it's not always when you're behind the wheel, anything motor vehicle related. The wheelchair accessibility example I mentioned, that client was actually an avid cyclist. So he was out riding his bike and got hit by an uninsured driver. So that's where the auto comes in. That's where that umbrella comes in as well. So it's really, again, a critical part of the exposure for households. Unfortunately, it's just not talked about enough in the mainstream market.
What's interesting to me, you've mentioned that. You mentioned how deductibles have changed to a percentage of the policy for roofing. There's a few other things you've mentioned where what I've seen is most people aren't looking at their policies, so they don't know this stuff. And then they're surprised when it happens. I've run into several clients who are just shocked that when they went to claim, something didn't happen the way they thought it might. So if we can say anything from today, go talk to your insurance agent, but also read your policy, because these things are, I don't like to say it too maliciously, but they do kind of get slid in year after year in the fine print, and people don't know that they changed.
Correct. And the insurance company shifts that responsibility to the insurance or to the client.
Yep.
Right. To the policy owner. They say, well, we gave you the policy, but it takes a certain kind of individual, Jon, to read through an insurance contract, right? Meaning you got to be detail oriented, or you got to be an insurance nerd like me.
Well, now we have AI. We just dump it in AI and say, what's changed?
That's true. And so those are the types of tools that consumers have to rely on. They have to put them in their toolbox. The conversation of having a resource like an agent or an advisor to help and discuss these things, that is really critical. Again, especially for folks who have a lot at risk, right? And, you're not going to get that from a call center, unfortunately, right? So understanding what's happening. And the other thing too, Jon, is the insurance world for decades, it was kind of on cruise control. A lot of the older generational agents, a lot of times it was just dust collecting on these policies, and the agents weren't being proactive. The only times there was interactions was if there was claims or a really significant price increase, right? But over, like I said, over these last 6-ish years, we've had so many changes. And people, I mean, I'm talking to them daily. It's just there is a disconnect understanding on what you have and what that the expectation of the consumer and what that insurance policy is truly going to be doing. We again keep talking about the shift of self-insurance for people. Again being dictated by the consumer, but it's also being dictated by the insurance company in the contract. So people do need to educate themselves. Using AI is a great thing to help. But even better is just talking through it, making sure that maybe you don't meet every renewal, but at least every couple of years, touching base with whoever you're working with and having a conversation and saying, "Hey, Crosby agent, what am I missed? What's changed? What can I expect moving forward?" Those are the things that, again, shifting from that commodity aspect to, hey, everything's a little different from carrier A to B to C to D. And the consumer does have to have a little bit more education on their side to make sure they're informed.
Well, as we wrap it up, I'm going to ask the question I always like, which is, what haven't I asked?
Well, if you haven't noticed, I certainly could talk about this all day long. So thank you for cutting me off, John. But I guess what's next, right? What do we see over the next 3 to 5 years? Um, Good news, like I was saying earlier, I think things are starting to level off for the consumer, right? Which is good. Pricing's going to look a little, at least stabilizing, going to look stable. Um, Underwriting appetite, John, is starting to increase. So we're starting to see companies adding more discounts, accepting fringe risks, somebody maybe with a couple of claims here, a couple of claims there. It's just starting to open up because it constricted so much over this correction period, that now things are starting to loosen up, and it's going to help the consumer. It's going to help for choice. It's going to help for really, people to possibly get even more competitive options there. The other thing that I would mention too is things are starting to shift a little bit with consumer needs. So, a couple of examples are like water damage and flooding we touched on earlier. More companies are starting to offer, as an example, hydrostatic coverage for a basement. And what that is very quickly is water collecting around your foundation. Somebody has a finished basement, water starts to creep in through the corners or the seams, stuff like that, right? Usually excluded. Companies are starting to offer that now. Companies are starting to offer private flood insurance. Historically, you have to go through FEMA, and you can imagine that lovely process. It's a little challenging. And imagine trying to settle a claim with FEMA. So companies are shifting towards a more private situation there. So specialty carriers, kind of the Chubbs of the world, Pure, et cetera, they're starting to offer that type of protection. And the other thing that's going to be probably part of everyone's home policy within the next, I would say, 8 years, 9 years, would be cyber protection. So as things continue to get more technology based, we talked about AI. Unfortunately, that's helping people. Well, it's helping people read contracts and understand their insurance, but it's also helping bad characters out there take advantage of people, right? And so, not to be confused with identity theft, because that's more of a monitoring situation, not monetary reimbursement. Cyber, which is being offered by a lot of times, John, it's going to be attached to your home policy.
Mm-hmm.
It's providing protection for phishing scams, social media issues, smart devices, smart vehicles, the Rivians, the Teslas of the world, ransomware, all of these things that households are now starting to face. We actually have great programs and resources to help people out if they are a victim of that. So I think that's going to be on more and more dashboards for people, consumers, moving forward. That's really going to be something that, and we're honestly adding it to pretty much all new policies that are coming in, and explaining it and educating people. And it's amazing how many times we hear people say, wow, you're right, I do actually have that exposure, or we had a close call because of this, right? So it's continuing going to be an emerging exposure for a lot of people. And again, weighing exposures. If you've got kids that are on social media, if you have a fine art collection and you're purchasing stuff and wiring money to California for X piece, you got to weigh where you're at. But there are really great programs that are emerging and already available from a lot of providers. So we kind of start to see that as a much more of a conversation down the line.
That's what I've seen as we moved along, is cybersecurity switching from just the business risk to now personal risk. So glad you brought it up.
Yeah, absolutely.
So before we go, why don't you tell us, Crosby, if people want to get a hold of you for any reason, where they can get you?
Just reach out to Cox Insurance Associates here in St. Paul, as you had mentioned. But we work, we're multi-state. So, we work in all 50 states. We're independent, work with multiple providers. And this is all we do. So we do business insurance on the property and casualty side, meaning homes, autos, businesses, vehicles, stuff like that. Health insurance, we don't do. Financial products, we leave up to you, John. Life insurance, we leave that up to everybody else. This is our lane. This is what we focus on. And yeah, that's so happy to be a resource for folks. And you can always reach out to crosby@coxins.net.
There you go. And if people want to talk to you for another 3-4 hours about insurance, you'll be available.
Oh, I'm a hit at cocktail parties, John.
There you go.
It's just thrilling. And sometimes they don't know what they're getting into. You should, my wife, she always usually just kind of fades off and walks away when we start to talk about insurance. Somebody has a question. She knows what's coming. So she just kind of like goes and does something else for a little bit. So
yep.
I appreciate the opportunity, John.
Yeah, thanks for joining us. This was fun. And if you'd like to catch more of my podcasts or anything here at BGM, you can join us at bgm360.com and feel free to reach out. Appreciate it, everyone.